My name is Nick Huber. If you found me through Mitchell's platform, I run a real estate private equity company and self-storage management company. We have 62 properties, 47 employees, 1.86 million square feet under management. Mitchell is an ultra high net worth CPA. He does my tax returns. He is my tax strategist. I mean, when I'm structuring a company, when I'm buying a deal, when we're raising money, Mitchell is the one who I pay the big bucks to help me get it all right. So it's pretty awesome that he is here right now to share a lot of things with all of you for free. Um, and I'm going to just start by saying, like, real estate has sucked the last year and a half. It has sucked. 2021 was fun. We could buy deals. We could raise revenue 25%. Millions of dollars would appear out of thin air. We were getting cocky and we were getting rich. 2022, a little bit slower year. We went from buying 50 million in 23 to 37 million in 2022. 2023 was a super slow year. We bought one deal worth $1.3 million. We underwrote. I was going through the data with my team this week. We underwrote over 1,000 deals, meaning we looked at 1,000 deals. We got the unit mixes. We put them through underwriting to potentially make an offer. We made 30,000 cold calls.
Wow.
And we bought one property.
So when are you going to give up, Nick? When are you going to tap out?
Well, that's what I'm trying to say right now is tides. I can feel it turning. Okay. Like my acquisitions guys are all of a sudden having great conversations. Brokers are calling us. There's distress in the market. If you can raise money, if you have money, now is an exceptional time to be a real estate investor. And I really think it's going to get better. I mean, I don't know how long it'll be painful. I don't think we're going to be making money in chunks like we were in 2021 for a while, but there will be really good deals to be found. That's why I'm so excited to talk about the tax advantages. So if you're a real estate investor, you're running a PE firm, or you're just an investor who wants to find a way to pay less taxes through real estate, we're going to teach you as much as we possibly can about how it works. Now, let me pull up I'm going to show a list briefly here of exactly what we're going to go over. So let's do that. I lost it. Damn it. I'm working on it. Mitchell, you got anything to say while I pull this up real quick for the people?
Well, I was referencing earlier, we were at a kind of offsite last week and somebody asked Nick and Dan Hagberg, Nick's partner, they said, when are y'all going to give up? How long will y'all wait this out? And they just said, we're never giving up. We're going to the end. And
Yeah.
I mean, it's really a tribute to like what you and guys like Chris Powers have done of building profitable companies that work even when you don't have to buy stuff.
The
That's
mistake
fantastic.
the mistake that so many real estate investors make, and we're not talking about tax right now, but the mistake that so many real estate investors make, especially syndicators who go out and buy deals, raise money, is they're not profitable in their own right. Meaning we have to keep doing deals to make money to then pay our people. Chris Powers set me down when I was very early in this journey and said, Nick, don't make that mistake. Charge enough money to manage the properties to where you can pay your good people. And it was the biggest blessing ever because we are not on a hamster wheel of we must do
Yeah.
deals to pay all of our great people. We have a sustainable real estate company, and that it really does one thing. It takes time and puts time on your side. Most real estate investors, a lot of real estate investors, time is not on their side. They need to do deals fast. They need to sell deals. They need to do more deals. We can hold deals. We can pay our good people. Time is on our side. So today, what we're going to discuss, this is a brief breakdown here. We're going to talk about bonus depreciation, which is the number one lever that you can pull. We're going to talk about what it means to be a real estate pro. We're going to talk about the short-term rental loophole. We're going to talk about recapture basis, what that means when you pay taxes on the way out, because all this, after all, is just a tax deferral method. It's not a tax savings method. We're going to talk about 1031s. We're going to talk about step up in basis, and we're going to talk about opportunity zones. And then we're going to talk about some other real estate tax opportunities. But we're going to cover a lot. You're going to walk away from this knowing a lot more about how this works and what we're all about here. Let's do depreciation first, Mitchell.
Fantastic. All right.
And what we're going to do is, I think the best strategy. I'm a layman. I don't speak CPA. I'm going to do my best to explain something as simple as possible. And Mitchell, then you correct me, add the nuance, add color to what I'm saying, and make sure I'm not making any mistakes. I think that's how we found is the best way for people to kind of start to understand this thing.
Fantastic. So depreciation, kick us off, Nick.
So when I buy a computer mouse or any kind of equipment for my business, I'm making payroll, I can deduct the full price year one. If I pay $30 for this mouse, I'm using it for business, boom, I can deduct $30 against my taxes and I can literally save 25% of that or 30% of it or whatever tax bracket I'm in. Now, when you buy a piece of real estate, you can't just depreciate it, deduct it all in year one on your taxes, even though it's a legitimate expense. Okay, there's a depreciation schedule and what the government calls a useful life for real estate. So if I buy this house, I'm working in a residence. I'm at my home right now. I'm in the basement. If I buy this house for $1 million, I can depreciate it, deduct it slowly against my taxes, and we had to pull out land value. We'll talk about that in a second. But we depreciate over 27 and a half years. So every year for 27 and a half years, I deduct the value of this house, what I paid for it against my taxes, or $36,300 a year. That's 3.63% of it. Now, commercial real estate has a longer useful life, like a warehouse building, something along those lines. It's 39 years. If I buy a self-storage facility and the buildings are worth, maybe I pay 1.2 million, the land is worth $200,000. You can't deduct or depreciate the land, but we have $1 million remaining. We depreciate that over 39 years or $25,300 a year. That's how depreciation works. So if I buy $1 million building divided by 39 years, $25,600 per year every year for 39 years.
Yep. So we're walking into the shallow end of the pool right here. So, think about items below, say, $2,500 that you can just say, these are supplies. This is an ordinary, reasonable expense of running this business. I'm going to write it off today. But when you get into, $10,000 of machinery or equipment or furniture or fixtures or, all the way up to humongous capital improvements like real estate, you're going to have to put those on longer timelines. So, 5, 7, 15, all the way up to 27, 39 years. And so that's the basic concept here of, is this a supply? Is it a expenditure, or is this a capital item that has to be realized and depreciated over time?
And let's say that this building, we buy a $1 million building. Let's say it makes $60,000 a year of net operating income.
Yep.
How depreciation is so powerful is that every year, this depreciation is a line item on your expenses, but not a real expense. So if you buy the property for $1 million, you get $60,000 of net income, you're deducting $25,641, 2.56% if this is a commercial building, from your taxable income every year for 39 straight years. That's 42% of your profits that are real profits that are shielded from taxes. Those taxes are deferred. And the great thing about this is that you can leverage, we're going to talk about the different pillars of real estate, but if you borrow $600,000, $700,000, $800,000 to do this, you still get to depreciate that as expense year over year over year.
So
it's a beautiful thing.
Into this very kind of like, everyone understands a bank account, or for the most part, if you sell $1 million and it comes into your bank account and you spend $400,000 on OpEx that just goes out the door, everyone gets that. But now we're getting into this kind of like second layer of accounting that is somewhat esoteric, which are these kind of like phantom costs. And yes, depreciation is a real expense in the sense that like entropy is real and everything around us is breaking constantly all the time. But your building is not breaking 1/39th of the improvement costs every year. It's kind of it's just a random number that the IRS puts out there and lets you deduct. So it's a huge opportunity, and it's a planning issue, frankly.
Now let's talk about useful lives and
Sure.
the IRS schedule that says, hold on, wait a minute. This whole house that I'm in, every bit of the house doesn't actually have a 27 and a half year lifespan, or every bit of a commercial building doesn't have a 39-year lifespan. There's other things that have shorter lifespans that you can depreciate those values quicker. Landscaping, sidewalks, parking lots, stormwater infrastructure, earthwork, carpeting, electricity, appliances, windows, doors, movable walls, overhead doors. There's all these different parts of a building that the government agrees actually don't even have that long of a useful life. So what you can do is you can put dollar values on these. You
Yep.
cost segregate. You pay an engineering firm to build a report for you that shows you all these different things and put dollar values on them. So that what you can do is you can give them 5 year, 7 year, 15 year lifespans, and you can front load a lot of that depreciation. You can get it quicker. So instead of maybe 3.6% year one depreciation, you can get, more like 8% or 9% for the first 5 years. And then you're kind of knocking off a lot of that depreciation quicker. And then there's this thing called bonus depreciation. Now, before 2017, there was really only bonus depreciation available for developers. If you built a building from the ground up, then you could do this thing called bonus depreciation, which makes a certain percentage of those first year costs all depreciable in year one. This is basically a tax. I like to call it a tax loophole. Tax Twitter hates that. It's really a tax advantage to incentivize buying real estate to where a lot of things with under what's the year lifespan, Mitchell, that if it's
Uh,
under a certain amount.
it's 15 and below. So, all the 15-year site work, all of that stuff is bonus depreciable. And then the 7 and the 5 year as well.
And what this does is it allows a real estate investor to buy a building and a good chunk. In self-storage, we bought some deals last year that 25, 30% of our purchase price was determined to be this, 15-year and under useful life things, movable walls, landscaping, earthwork, stormwater plans, things like that. All that value got lumped into what's called bonus depreciation eligible. And
Yep.
this allows you to deduct it against your percentage. Now, back in 2017, it was 100% bonus depreciation. All this stuff, year one. 2018, it was starting to phase out. 2021 came. The CARES Act went, to fight the pandemic, allowed, for 100% bonus depreciation for 21, 22, and 23 stepped down to 80% bonus depreciation. 24 steps down to 60% bonus depreciation. Now it's back in front of Congress, actually this week, to potentially be back up to 100% bonus depreciation, which we would have a big party in the real estate world if that were to happen. But this stuff gets really powerful. Anything I missed there, Mitchell, before we jump right into an example so we can start to wrap our heads around how this works?
Yeah, I think everything I'm talking about will hit into this example. But, we started with this $1 million big industrial building. So we're going to take the land and separate the improvements. Land is not depreciable. Land just kind of sits there forever. Hopefully, land always holds its value. And then, yeah, ordinarily your CPA would just say, oh, you have $1 million of improvement. We're just going to divide by 39 and take it once a year. What Nick's saying and what we do at RE Cost Seg is picture in your mind's eye one of those blueprint blowout diagrams with every piece of the building. We try to take the building and put it into its component parts, assign every one of those parts a life. And some of them are 39 years, some are 15, some are 7, some are 5. And all of the short life property, we get to take a massive tax savings right up front.
There's a lot of questions about, can I do this to a primary residence, a house that I'm living in? And the answer is no. It has to be an
No.
investment property. It has to be a property that you are trying to make money on. Somebody's paying you rent. But let's run through an example.
People even say like, hey, I have a renter in my basement, but we live upstairs. Should I do it? And generally, even then, we recommend no. It's just too much brain damage.
Yep. So let's run through an example. We buy a property for $1 million, $200,000, and this is all right in front of you. $200,000 of it is land value. So we have $800,000 left that our cost segregation study has shown is applicable to the building. Now, 30% of it is 5 to 15 year. This is an example. 30% of that building value is between 5 and 15 year useful life, or $240,000. 240K is the bonus eligible amount, of which 80%, this was made just before the beginning of the new year. So 80% of that, which is 192,000, could be taken as a year one deduction if you were to close on that and put it in service in 2023. 60% of it, if you were to do it today, close today in 2024.
That's 144. Ugh.
And look at how powerful this is. Okay. You have $1 million asset that you bought, and it's going to produce about $60,000 a year of profit for you, taxable profit, net operating income. $192,000 deduction on it is literally carries forward an operating loss of $132,000. 13.2% of the purchase price if you were to close in 2023. That's a little lower, more like about 8 or 9 to 10% if you were to close in 2024. But, that's a massive advantage. You bought an asset that made you money in that year. You used a lot of bank leverage potentially to buy it, and you took back a $132,000 net operating loss on the purchase price.
Yep.
This is the magic. This is what happens when you hear, who, paying $700 in taxes when they were trying to find his tax return back in 2016. Like, this is how real estate investors can make millions of dollars and pay almost nothing in taxes because they're buying property every year, accumulating this bonus depreciation, and it's offsetting income from other assets and other types.
Yeah, and this is a great example in that, like, put $500,000 down to buy $1.5 million property. So this is an extremely high leverage. I mean, it's moderate. And then, getting $250,000 to buy $1.5 million building. This isn't a knock it out of the park case. This is a very kind of ordinary outcome for folks that we work with, which is, you put $500K down, you get a $250K deduction, and you can watch that get worked down. It's 192 last year. It'd be, 140 something this year. But, it basically takes dollars that would have been equity dollars into a deal and gives you a deduction in the current year for those dollars, which is really valuable.
Yep, super powerful. So I'm going to do a quick shout out. There's a lot of people asking questions right now in the Q&A. Hey, how do I figure out what percentage of my building is eligible for bonus depreciation? Yep. If you go to recostseg.com right now and fill out the quote request form, we'll send you a free proposal that tells you what the study costs and exactly, or not exactly, but a very close estimate of what the depreciation will be. Now, I don't want to spend a lot of time pumping RE cost seg. You can use any kind of cost segregation firm that you want, but you need to reach out to a cost seg firm. They'll give you a free proposal that'll show you, how much potential tax savings year one you'll get. You can do this to properties you're under contract on. You can do this to properties you bought. And the interesting thing is, Mitchell, we can carry this back a few years too, right? So if you bought a property in 2022, 2021, 2020 that you never did a cost seg study on, go to recostseg.com, fill out the form, and check that out. Now, the 5 levers of bonus depreciation, Mitchell. Let's walk through this a little bit. So these are basically the levers that you can pull or that you look at to figure out how much savings you could potentially get.
That's right.
Deferral you could potentially get.
It's savings for now. It's deferral later. But yes, yeah. So this is how we think about it. And you just said, hey, everyone's asking, how do I know what works for my building out there? And this is how we know. And this is how we think about a deal when it comes in the door. And we get a lot of this. So let's go back to this $1.5 million warehouse that we're talking about. So lever one is, what is the land value and what is the improvement value? There's the best way to calculate that value is by the county appraiser. They're this kind of neutral third party. So when you go to the county's website and they have your property appraisal, we look at the land value versus we look at the improvement value per their records. So, a shack in Manhattan versus, a huge warehouse in a cornfield in the middle of nowhere, one would have a lot of land value. One would have,
and land value is bad. So that if you're in a property, if you're in an area like Manhattan or you're in Southern California where land is very valuable, that lever is lower. It's a higher percentage of the value is land, and you're going to get less bonus depreciation. Like buying a duplex in rural America is going to have a higher percentage of depreciation than buying a crappy duplex in Washington, D.C. because the land value is higher in D.C. So that's kind of a way to think about that first lever.
Yeah, because look, if you can't, if you can go buy a brick house with a 3-car garage for $350,000, it's a whole different deal than when you go into Southern California and you get nothing for millions of dollars. There's a lot of questions.
There's a lot of questions coming.
Sure.
Can I cost seg a condo? Can I cost seg a garage? Is it short-term rentals or long-term rentals as well? The answer is, if it is a for-profit piece of real estate,
Yep.
you can be eligible for bonus depreciation, and you can do a cost segregation study. So if it's a
Yeah.
for profit, if you own a condo, a beach house, a short-term rental, a long-term rental, anything that you're trying to make money on, also a warehouse that your business could be in,
Yeah.
these are the areas where bonus depreciation starts to thrive.
We've cost seg, $200,000 small rent houses, and we've done $200 million portfolios of office buildings. So kind of everything in the middle. Real property is available for this. And again, you go to recostseg.com, you fill out the proposal. We tell you exactly what you kind of might return within the kind of range bound for this. So,
Let's rip
yeah.
through these other let's rip
Yep.
through some of these other levers. So, and I'll kind of do my best to talk through them. You can add anything
Yep.
that might be necessary here. So, number two is the percentage of the property with useful life, 15 years and under. That's stuff that's not doesn't have a full 39-year depreciable lifespan. The appliances, the windows, the landscaping, the sidewalks, the garage doors, any movable walls that you have, all that stuff. More of that means more depreciation. Lever three is
Sure.
the amount of money that the bank gives you, because the bank is going to amplify your yield. The bank doesn't take any of the depreciation. So if they give you half the money and they don't get any of the depreciation, it effectively doubles the percentage of depreciation that you'd get if you bought a property with cash. Now, since debt is more expensive, that lever is working against us right now, since we can use less leverage to buy real estate generally.
Sure.
Now, lever four that you look at is, what's my tax rate? If I'm in a really low tax rate, I'm not claiming a lot of income, a cost segregation study, a lot of bonus depreciation, that's not going to help me necessarily. But if I'm buying real estate in Manhattan and I'm in a 51% tax bracket, the returns of a bonus depreciation amount are going to be higher. And then
So
lever five is
the
the year that you're doing this
yeah.
stuff. And is it 2024 where you're at 60%? Is it 2025 where you're at 40% and it's going to phase out? But the bonus allowable percentage also really matters.
Yeah. So, percentage of leverage, if you put $1 down and get the building and you have $1 in, your payback ratio is going to be almost infinite relative to that aspect of it, versus if you put $100,000, or if you put 100% cash down, it certainly mutes your returns here. And then, yeah, this whole thing is an arbitrage on tax rate, meaning what is my tax rate today and what will it be in the future if and when I sell this? And then it's an arbitrage just on being able to use the money over time. Because again, this is a deferral. You're going to owe it back to the government one day, but there's no sense in doing this while you're in an 18% tax bracket and then paying it back at 51, right?
Yep. Let's do this case study later. There's a couple case studies here of ones that we've done just as an example. I guess we can just touch on the highlights here. Is that a self-storage warehouse, 22% of the purchase price was eligible for bonus depreciation. 22%. That's because their self-storage has a lot of movable walls. It has a lot of underground retention. It has a lot of earthwork. So 22% of the purchase price on, actually, this is one of the buildings that I bought, was eligible for bonus depreciation. An industrial portfolio, they're not movable walls. There's a little bit more land value potentially as well. So it's a 10.7% percentage of, and we got a question up here, what asset class is the best mix of potential bonus depreciation? So we're going to run through a couple of these. Industrial building, 10.7%. A short-term rental, what was the percentage of purchase price? This one actually doesn't have it listed.
It was, 222 divided by 550. So, I mean, that was close to
Almost
40.
50%. Yeah,
Yeah.
46% of it.
That last lever, that lever number 6, is really the payback ratio, which is what are you going to pay today for us to do this study and for you to deal with it, versus what immediate savings are you going to get today? I mean, that's a huge factor. And you can see where they paid $2,800 for $663,000 of immediate. Mm-hmm. And that's net. That means that's what they got in addition to what they were already going to get. So
now let's talk about the different types of income in the eyes of the IRS and who gets to utilize this bonus depreciation and who doesn't. Now, there's something called, I'm going to oversimplify it. Now, there's a lot of nuance here, but there's basically two types of income. There's active income. This is what you're mainly focused on, maybe your W-2 job or a primary business that you own. That's income that you actively earn. And then there's passive income that maybe if you're just an investor in a business and you don't have a role in it, you don't spend time on it, it's passive income. Now, if you're a limited partner, an investor in a real estate deal, and you're not what's called a real estate professional, meaning your primary business is not the business of real estate, then you can't use passive losses from real estate investment to offset W-2 income. Now, most of the people that reach out to Mitchell say, "Hey, Mitchell, I got a tax problem. I make a ton of money in my W-2 job. How can I pay less in taxes and defer more of it into the future? I want to buy real estate. I want to get bonus depreciation. I want to offset my active income." You cannot do that unless either you are a real estate professional in the eyes of the government, or your wife or spouse or husband is a real estate professional in the eyes of the government. If one of those two people, marital participation, um, matches that, then you are a real estate pro and your passive and active losses can offset each other. So an example is I'm a real estate professional. I also own a small business on the side. My small business generates about $1 million of taxable income for me every year. But I also have made a lot of real estate investments. I own a lot of real estate, and I got $2 million of the bonus depreciation passed to me last year. I actually can shield and defer the taxes from my W-2 main business, and some of my other side businesses to to defer more taxes. Works out great.
Yeah. So, this gets into the title of this slide is almost like, why should I not do this? And, the one big reason is you just can't utilize the losses. So, real estate rental income is passive by nature. And so if you don't have other passive losses to utilize, or you're not a real estate pro, you just shouldn't do it. It will not provide an immediate benefit unless you have other passive income going, or unless you have some other big strategy. I mean, ultimately talk to your CPA about doing this. Other reasons you shouldn't do this. Again, you're in a low tax bracket, or, the payback ratio is just not good because the property is too cheap, or you're going to
Mhm.
immediately sell it. I mean, this is a deferral. So if you're going to go turn around and sell it,
Let's talk a little bit about what it means to be a deferral. So
yeah,
how should we think about this money that we are saving? And you taught me this. I'm going to kind of repeat it as simply as I possibly can. You told me that, hey, Nick, look, we have this year bonus depreciation. It offset, about $700,000 that you would have paid in taxes. $700,000, instead of paying that in taxes, you kept that money, 700 grand. So look at it as an interest-free loan from the government, meaning
yep,
you are going to someday owe Uncle Sam this money, whether you sell the asset. Eventually, when you sell the asset, the basis is going to be reset. We're going to talk about recapture in a second. You're going to owe the money. So would you rather pay the $700,000 now, or would you rather pay the $700,000 in 5 years when you plan to sell a building? The
that's
answer to
right.
me as a real estate investor, and knowing how valuable capital is and how I can actually grow that capital, make more investments, the answer is pretty clear to me that I would rather defer the taxes into the future. But if I were to sell my asset next year, maybe I'm a house flipper, right? Maybe I buy a house and then I want to sell it the very next year for a profit. A cost segregation study and bonus depreciation, all these things we're talking about kind of go out the window. The government here is incentivizing us to hold on to real estate and take care of it for a long time. So that's what they want us to do. So if I were to just to flip and sell real estate quickly, these tax advantages, almost all these tax advantages that we're going to talk about in this presentation, actually don't really work.
That's right. I mean, you're getting into this kind of, again, esoteric tax idea of what you're really creating is a deferred tax asset. So, like, meaning you took a deduction today that you weren't ordinarily entitled to until, 39 years from now,
Mm-hmm.
when you blew this whole building apart and pushed the depreciation way forward. And so you really, or no, sorry, you're creating a deferred tax liability. So like, you owe the money in the future. The IRS is loaning you money. They just don't know they're loaning it to you. It doesn't really like, if you were Starwood, if you were a big REIT or a big public real estate company, you can go look at their balance sheet and see a deferred tax liability sitting on their balance sheet. But you are just, shooting your you know net worth statement to your bank. This deferred tax liability doesn't show up on there, but it exists. I mean, when you sell the
Mm-hmm.
property, you're going to owe the money, but you're getting to use the money rent free. And today, you can get a real return of 5.5% risk free. So
Yep.
You know,
Let's pop back in. Let's pop back in here now and talk about recapture and what it means.
yep.
Recapture is the tax liability sneaking up on you in the future when you sell an asset. That's the simplest way to explain it. So, if you buy a building for $1 million, you take 250K of depreciation. Your basis, instead of $1 million, is now 750 grand in the eyes of the government. So anything you sell for over $750,000 is between that 750 and the million of original payment. That's the recapture stack amount, and you're going to owe recapture tax rate on that amount, which is active income tax rate. Is that correct, Mitchell?
Yeah, and so again, what goes down must come up. This is just Newton's law of tax out there. So there are ways to mitigate recapture. There are ways to plan around recapture. There are also ways to defer recapture by using opportunity zones, by using 1031 exchanges, by dying and stepping up the basis, by by structuring sales through installment sales. I mean, there's a million ways to mitigate this. But if you buy it today, depreciate it, and then just go sell it, it's coming right back around.
And somebody says, how and can the depreciation be passed to investors on a property? And yes, according to ownership percentage, generally depreciation is passed down to investors in a property. Somebody else says, what if have a W-2 working for a property management company? Can I qualify as a real estate professional? I think the answer is only if you own 5% or more of that business. So if you don't have 5% equity in the property management company and you're simply getting a W-2, the answer is no, you're not technically a real estate professional.
Yep, that's right.
Good.
And there's also something called excess business loss rules, meaning you can only deduct so much of your W-2 income.
You swallowed some water down the wrong pipe, Mitchell. Go ahead and try to hack that up. I'll do the best that I can here in the meantime. But yeah, what he's saying is like, unless you have capital at risk in the form of you're personally guaranteeing a loan or something's going along those lines, you can't deduct more than you have at risk or into a property. So there are some rules around how much losses you could potentially take.
Also, just if your husband's or wife is a hedge fund manager who makes $20 million a year as a W-2 employee, and you're a real estate pro, you can only offset, $500,000 against that $20 million. You can't wipe out an entire W-2 that's an unrelated business interest. So,
okay. If you're watching this, we hope you're getting a ton of value. We're going to keep cranking through real estate tax savings. We're not going to do a whole lot of promotion, but go to recostseg.com if you bought a piece of real estate, fill out the form, and we'll get you a proposal showing you basically how much money you could potentially save. So let's talk about the STR loophole next, Mitchell, because a lot of folks out there have a high W-2. They're buying what are essentially second homes on the beach, and they're renting them out primarily as a cash making investment. But the average length of a stay is less than 7 days. They're short-term rentals. They're Airbnbs, and this is there's a loophole around this where actually this can be documented as active income, and active losses. The depreciation can offset active income because you're involved in the business of managing this short-term rental. So here are the rules. There's a lot of nuance around this. Obviously, talk to your own CPA, but if your rental averages 7 days or less, or 30 days or less, and you provide substantial service to the people while they're there, cleaning, whatever it might be, and you must materially participate in the management of that property, meaning you're spending 500 hours a year or 100 plus hours and substantially more than anybody else, and you use it for less than 15 days. That's the master's, or no, that's not the master's rule, but 15 days that you use it less than that. This can basically be counted as active income, and the cost segregation study and the bonus depreciation that you take can offset W-2 income in this manner.
Yeah, so we just threw a wet blanket on everybody and said you have to be a real estate pro. Well, now we're getting into the ways that you can access bonus depreciation without being a real estate pro. One is the STR loophole. The other is, let's say I'm an accountant and I buy an office building for me to operate my accounting firm out of. That becomes an effectively connected business with my accounting firm, and therefore I can take the losses against that. So that's essentially what an STR is. You're now running a hotel operation that incidentally occurs in real estate you own, right?
Now let's talk about a disaster scenario, because there's actually some stress out there in the real estate market right now. Jake asked a good question. If I sell for a loss, could I still potentially have a tax liability? Could I still potentially have recapture to pay? Now let's look at this page. Let's look at this page right here and talk about how things can go very poorly Let's say you buy a building for $1 million. Let's say over 3 years, you depreciate 250K. You're using that to offset your other taxes. All is good in the world. And let's say you actually borrowed 800 grand from the bank when you got going. So you bought it for $1 million. You put 200 grand of your own money in. You borrowed $800,000 from a bank. Things get tough. Maybe it was an interest only loan. And the bank says, hey, actually, your building's now worth less than $800,000. We're going to force a sale. And let's say they go out and force a sale, and the sale is for 800 grand. You depreciated $250,000. The bank gets paid back. You made zero money. You got zero money back. But in this example,
You
you'd actually
lost
have
all your equity in the middle of it.
you
Yeah.
lost all your equity, and B, the difference between $800,000 and your basis is now $750,000. There's actually a taxable gain on paper there, and you can actually owe taxes while you're getting crushed on. This happens a lot with jets, private airplanes. Guys
Oh
will
yeah.
they will buy airplanes. They'll depreciate a massive amount of them, and they'll end up being underwater on the airplanes, basically, sell the airplanes, and all of it becomes taxable income because of the bonus depreciation is applicable to the entire plane. And it's just, it can become a disaster scenario. So be really careful when you're thinking about what Mitchell said with the deferred tax liability. The government will come calling and you will need to pay these taxes.
Yep. Planes like that, you always have to replace it and replace it and replace it. You chase your own tail.
Just like Section 179 with large vehicles too, because
Yep.
when you buy a $150,000 work truck, you get that Section 179. You can write off the whole thing. That's amazing until you go and sell that truck for $100,000, and it's all taxable income. You got to go buy another $100,000 truck just to offset it.
Love it.
Okay, this is going really well. Keep the questions coming, guys. Me and Mitchell are taking a look at the Q&A, so you can post over
So
there and get some things answered.
how do real estate pros like property managers who don't own the properties utilize this approach to claim deductions and save on their taxes?
That's a great question.
Property managers, people in construction. I mean, there's all these kind of classes of real estate pros that aren't necessarily real estate private equity syndicators. I mean, it becomes tricky because you have to both be a real estate pro and materially participate. And we talked about that for like the STRs. It's either 500 hours or more than 100 and more than half your time, or I'm sorry, more than anybody else on the activity. And so if you just write checks to Nick Huber, if he can ever buy real estate again so that he can buy real estate and pass through losses to you, it's really difficult to materially participate in that activity. It is passive by nature. So you may just have to go buy real estate or I'd recommend you talk to your accountant. It should
Yep.
go without saying, but let's say it. I am an accountant. I'm not most of your accountants except Nick over here. And we're in the deep end of the deep end. Like, do not make this decision because you read something on Twitter or listened to a 40-minute webinar. Go talk to your CPA, get your CPA on board. Nick will give you a full diatribe on how he thinks about CPAs.
Actually, can I go ahead and do that now? Because
Let's
I think
go.
a lot, I have a lot of real estate investor friends who are very clearly real estate professionals, and yet their CPAs are very afraid to take depreciation to offset their active income because it's more work for the CPAs. They got to file more forms. They got to chase down cost segregation studies. And 10 years ago, a cost seg study, the minimum price for a cost seg study was $5,000. We're doing cost seg studies at RE Cost Seg for $750 because we can do virtual site visits. We have some overseas admins,
It's
and we're getting
$895 now, Nick. We've had to raise prices. It's tough.
well in
out there.
general, like still it's 20% of what it costs to do a cost segregation study in the old days. So, um, you know, CPAs don't actually think it's worth it a lot of times, and it's a real shame.
Yep.
It's a real shame. So if you're a real estate pro, or even if you have other passive income to offset, a lot of people realize that, hey, I own a lot of old real estate that's cash flowing. I'm making 100 grand a year from old real estate. I'm paying taxes on that. Even though I'm not an RE pro, this depreciation can go in an account and it can be carried forward and it can offset all of your passive income from other investments. that are similar type income. So
Or I put the one check into a restaurant that ever paid back, and I make 100 grand a year out of this restaurant deal. Like,
Mhm.
passive losses can offset other passive gains, and so there are people
And
who
investing short term capital gains in the stock market count as passive gains too, right? So you're
different
uh,
deal. It's
different. Never mind.
they
That's a
break
third
it
type.
into 1,000 boxes. Yeah. So
Okay,
any
I love it.
any income can offset any loss, but only certain losses can offset certain incomes.
Doug
That's how.
says, if you work full time for a global public real estate brokerage firm, can you qualify as a real estate professional? He said 5% ownership is virtually impossible for me. I would say, Doug, that you need to find a spouse that is a real estate professional to get that status for yourself.
Is TurboTax a good replacement for CPAs that are scared? No, it's
No.
really not. Good luck. I know you're not scared, so go for it. Good luck.
Yeah. Let's rip through a couple more of the awesome tax benefits that are in place for real estate investors. And I think a 1031 exchange is really an awesome thing. If you hold a piece of real estate for more than 1 year, you go to sell that piece of real estate, presumably for a profit, and you're going to have a tax liability. You can claim this as potentially, you're going to go out and identify another replacement property of like kind, meaning these properties this is also called a like kind exchange, a 1031 exchange. You can set aside these profits, put them in an escrow account, and you can go deploy the capital into a new real estate investment, and the basis changes, but there's no taxable event. It's like if Google stock went up from $100 to $200, you sold it all, but then you went and bought Apple stock because it's a very similar company, and there was no tax event there. Of course, you get taxed in public equities, but the government allows you to kick the can further down the road by doing a 1031 exchange. Now, Mitchell, what are some of the nuances of a 1031 exchange that people should know?
Yeah, I mean, you have a certain amount of days to identify and a certain amount of days to transact. A lot of people,
You
there's
need a
a
good attorney to
saying,
help you do this.
you need an attorney, a qualified intermediary who handles these exchanges, who holds the money so that you don't get mixed up in it. But the saying goes, there's no better buyer for a seller to sell to than somebody on a 1031 up leg. Like, time is not on your side when you go
120
do it
days, is
in
that right, Mitchell?
180. You have
You have
45 to
180 days.
identify. Yeah, yeah.
Yep.
But it allows you, if I bought the building for 2 million and depreciated the thing to practically zero, I can go buy a $3 million building, and now I'll have $1 million of basis and carry the whole thing forward and not get recaptured.
Can
So,
I start depreciating that new building? So even though my
yep.
actual basis is $1 million, but I just bought a $3 million building, can
So
I
now
take a full?
you'll take $1 million of depreciation out of the new deal.
That's the
You
max.
can take all your new basis, your fresh dollars in. And
That's
so
awesome.
that works nicely with step up in basis. People say buy, refi, die. I mean, this idea that if you can perpetuate these exchanges long enough, when you die or when the owner of real estate dies, the real estate passes through their estate, meaning the ownership interest passes through their estate. And when it comes out of the other side of their estate, it has a new basis of the fair market value at date of death or 6 months after, whichever's higher. So if when you die,
Let's
you
run
do
through
not
let's run
have
through a scenario. I
recapture.
like talking about,
Yeah,
just in case I die. I've been doing some planning around that, so it's not as awkward anymore.
yeah,
Um, let's say I buy $5 million worth of real estate over time. I get old or I get hit by a bus, and I get hit by a bus and my real estate's worth 10 million bucks.
yep,
I have $10 million worth of real estate. It's already been fully cost segged and depreciated. I have almost no basis. Let's say my basis is 500 grand because I held it for 20 years. I'm about to hand it to my kids. Now I got Timothy and Everett who are my kids, and they get this $10 million worth of real estate. And you're telling me that if they were to, right after I die, sell this real estate to go buy, Lamborghinis and Ferraris and just waste all the money,
yep.
they wouldn't actually have a tax liability because the basis would step up to fair market value.
That's right. And if they, called me and said, "Hey, my old man just passed away and he left me $10 million of real estate, and what do I do with this?" I would say, "Well, we're going to go place it in service. We're going to cost segregate it, and we're going to bonus depreciate the crap out of it." And,
Hit it
you know,
again.
assuming
So
Hit it again.
they could potentially be given $10 million worth of real estate. We run cost seg studies on it and figure out they got $1.5 million
Yep.
to deduct year one. And that $1.5 million can come through as a tax loss on their income and offset a lot of their other passive income, or if they're a real estate professional, their active income.
Last night I sent out the email reminder to like come to this webinar, and a guy said, I need to be your example. This thing works. My dad bonus depreciated all of his real estate. He paid no tax. He got all this money back, and then he died, and I got it, and I got to step up in basis. And I was like, oh man, sorry about your dad, but
That's awesome. It
congratulations.
definitely will make me dying a lot easier on
It's
my
just
heirs to take when they get a lot of tax-free money. It's gonna be a profitable event for them when I kick the bucket.
oh well, we'll miss you, Nick, but
Yeah,
so
I love it.
uh, what were the other one? Oh, opportunity zones.
Let me
In
do my
20,
best here. You can
yeah.
fill it in. So in what year? 2017?
Yeah, this was a Tax Cuts Jobs
Yep.
Act thing along with 100% bonus.
Yep, we can thank yellow hair guy, orange face guy. But they basically set aside these areas. They drew them on a map. They circled areas and said, "Hey, these are areas where we want to incentivize development and growth." They circled a lot of areas that were poor or whatever and needed a lot of and they wanted capital to flow in. If you buy a piece of real estate in what's called an opportunity zone and you improve it a certain amount, you have to actually develop it and make it better. You got to put money into it. I think you have to do actually another 50% more than what you paid to qualify it for an opportunity zone. And then you hold that for 10 years. You can sell it at the end of the 10 years and have zero capital gains. So, and they actually let you set aside capital gains in the first place as, targets for opportunity zones. So let's say I own a bunch of stock. Say I own a bunch of stock. I own Apple stock. I've had it for 10 years. Let's say it's worth $10 million, but my basis is like $1 million. It's 10x.
Yep.
I sell all that Apple stock and I have a $9 million capital gain, coming, a lot of taxes. I can say, hold on, I'm going to actually earmark this for an opportunity zone. So I'm going to set aside this. I don't get taxed, and I have a certain amount of time to buy a property in an opportunity zone, put more money into it, improve it, make it better, invest in that neighborhood, improve that community, hold it for 10 years. And if I sell at that point, it's totally tax free.
That's right. So you can take that whole 9 million, although those taxes are supposed to come due in 2027, but that same legislation, they're trying to kick the can down the road on that too. So
Mm-hmm.
it's a it's a complex strategy. It's a whole ordeal, but it's something that you need to know. When you're buying a piece of property, note if it's in an opportunity zone or not, because if it is in an opportunity zone and you already like that deal and you're already about to do some development or some major redevelopment, you're selling yourself short if you don't look way into how to capitalize this and get all the tax benefits out there.
Scroll all the way down to the bottom, Mitchell. We have a really good question from Chase. It's going to be a great example. I don't know if I can show people this, but he says, he says he's trying to clarify how all this works. And this is a great
Yeah.
recap of what we've been talking about. If I buy a property for $1 million and I bonus
Yep.
depreciate and I get a cost seg study done by recostseg.com, I depreciate it down by $250,000 and my basis is now 750 grand. If I do that, and then I sell it for 1.25 million. In the normal way, if I sold it for 1.25 million, I'd have 250K of recapture and then
Yep.
250K of capital gains if I waited 1 year or more.
That's
But
right.
if I did a 1031 into a $2 million property, um, can I cost seg the new property at $2 million or at my paper basis of 1.5 million, 2 million minus 500K that I already depreciated?
Yeah, it's basically done the latter. You will have 1.5 million of basis, pro rata across the new asset to be able to bonus depreciate over time.
Okay,
Chase
beautiful.
is a long time RE Cosseg supporter. We love Chase.
Thank you,
So
Chase. We appreciate that. Um, let's see. Any other questions, guys? Ask any other questions you might have here. We're going to run for another 10 minutes here. Also, if you have any feedback for us, just let us know how we're doing. If this has provided some value to you, Mitchell, do you see any more that you think you might want to
um,
touch on?
Jesse asks, what do you think about DSTs to get out? DSTs are Delaware statutory trusts. They're kind of like REIT type um, uh, vehicles that you can 1031 into. So you can essentially roll your gain into one of these DST products. I would say they're they're high fee and somewhat underperforming. What most people don't go into DSTs. Most people would never think about it. So it's a tough product. Yeah, I wish they were better.
Yeah, I
Um,
think we have another question. I have to find a way to get my CPA comfortable with me claiming our, real estate professional status because of my W-2 income. And I think my advice to you is just like take ownership over your tax situation.
yeah,
Like, yes, you should get advice from people like Mitchell, but you need to just actually spend the time to read the tax law. It's not that complicated. Too many people that I know that make so much money, they have chosen to totally punt all of their tax planning and all of their tax strategy to the point where they don't even understand it. You're operating from a horrific point when
yeah,
you're getting advice because you can't fact check it. You don't know what's going on. If your CPA is not comfortable with you claiming that you're a real estate professional, but you believe you're a real estate professional, go do the work to record your time. Make a
it,
spreadsheet, record all the time that you're doing, talk about how you're involved in your businesses, and build a case, right? I think the best CPAs, they notify you of the risks, of course. They're going to notify you if you're breaking any rules, of course. But then there's also so many areas where, hey, we're just going to be prepared for both things. And if for some reason in the future, you get shot down as a real estate professional, this is the amount of tax that we might owe. Let's keep that on hand and do this stuff. I know that that's not, I'm not necessarily advising that's how you operate, but
yeah.
you really need to take ownership over your tax strategy and your tax planning.
100%. Also, if you are a full-time W-2 and you also want to be a real estate pro, that's a brutal fact pattern that
Hmm.
because it's a bright line. You have to work 750 hours and more than half your working time in real estate. If you work 2,000 hours at one job as a dentist, it's hard to argue that you're also 2,000 hours in on your mobile home parks.
Yep.
So,
And Drew says, are you guys going to cover any land development tax hacks? And I think another just overarching theme of the tax code when it comes to real estate is that if you buy and sell real estate, the tax code is not nice to you. If you buy a piece
yeah,
of land, build a building, and sell it, the tax code is not nice to you. I guess the one piece of advice that I would have, and Mitchell would agree, is hold the property for more than 1 year so that
sure.
you're taxed at capital gains instead of short-term gains. That alone can, be double the tax rate if you sell a property in less than a year. There's nothing less tax efficient than being a house flipper or a house developer that sells buildings after they spent 6 months building them. So
Just being a merchant builder is like the worst business in the world. You're carrying so much risk, especially if you're buying the property, taking all the risk, creating all the value, and then it's basically inventory and you just flip it. That's a
we have a really
bad
good question
outcome.
here. We have a really good question here. If I bought a property back in 2018, but didn't know about cost segregation and I never did a cost segregation study and never took depreciation, what are my options and what should I do?
Oh man. Did you plant this one? So there's a couple of options. One, you can go back and amend your returns, but you can't amend your return from 2018 because it's been longer than 3 years. The tax year is closed. It closed in 2022. So we do cost seg studies all the time for even big groups that just never knew this existed. That have we did a group for $100 million big portfolio where we came in and did about 10 cost seg studies for these people and their investors. So you can do it in the current year and file this form 3115.
And then you get the depreciation that was 2018, 19, 20, 21, 22, and 23. So you can basically get 5 years of depreciation all caught up that year.
Yeah, so you change the accounting method, and instead of taking the current year depreciation, you basically catch up the balance sheet. You take every bit of depreciation to make the depreciation right as of the end of 12/31/23 out there.
So basically, what Mitchell's saying is if you've bought property since 2017, after 2017, and you
Yep.
haven't done a cost seg study, go to
Pause.
recostseg.com. Go to recostseg.com, fill out the form, and we'll get you a free proposal to let you know how much tax deferral you could potentially get. We have a really good question from Blake as well. I'm a GP in a ground up development. That means he's putting it on, he's raising money. I also have a W-2, but I'm phasing out to Real Estate Pro in 2024. In 2024, once I jump to full-time real estate professional, is my W-2 income from Q1 and Q2 eligible to deduct against my RE Pro situation in Q2 through Q4?
So again, it'll be your whole 2024 year, and you'll measure how much time did you spend on real estate that you own that you were a principal in versus how much time did you spend working at your W-2, and you're going to take 750 hours, and more than half your time will qualify you as a real estate pro. So if you quit your W-2 job in May and then work the rest of the year as a real estate pro, you'll be a real estate pro out there.
Love it. Marty has a good question. If I get audited down the road and I show the IRS a cost seg that I got done from RE cost seg, will RE cost seg help me with the IRS? Is this included with the
100%.
upfront fee?
Yeah,
And the
yeah.
answer,
So
the answer to that is yes. We stand by all the cost segs, and if you need help, if they need more proof, if they don't like any part of it, we will continue to do work on that individual
so
cost seg for you.
the IRS has this whole process and how they audit cost segregation studies. There are 13 elements of a great cost seg report, and we built our entire process to meet that spec. So if you were audited, theoretically, you can just hand them our report and it will have the 13 elements of a quality cost seg study. All their questions will be answered. They can take like a 2-week vacation and say they were working the whole time, and then they'll come back and give you $1,000 back or something.
When does the clock start for the 1 year hold period on real estate that you develop and sell? It's on closing day. Is that right, Mitchell?
Well, if I bought a piece of land and built a building and got a occupancy certificate and put renters in it, it's either the certificate
Let's
of
say here's an
occupancy.
example.
Yeah.
Let's say I buy a piece of raw land today.
Yeah.
Today is January 22nd, 2024. And let's say I spend the next year building the building, and right as soon as it's done, I sell it on January 23rd, 2025.
That
One
is
year and
not a
one day.
long-term capital gain. It will be the day that you get an occupancy certificate and you start operating the property in earnest. So let's
So
say
it's putting
you
it in service. I see. So you must put the building in service and then hold for a year. So that makes it even
yep.
harder for developers to get favorable tax treatment.
Redeveloper, if you bought a storage unit and then went and built another, section of it on a separate pad and were, doing everything you do to add value to properties the whole way, you would have put it in service day one and you would be able to sell it after a year. But if you're starting from nothing, then you have to wait until placed in service date, which would be occupancy certificate.
That's awesome. And look, Mitchell is graciously giving us his time, and I think we're getting a ton of advice from this. Do him a favor, go to recostseg.com, fill out the form, put in the details about your piece of property, and just consider us for your cost seg needs. It's half the price of our competitors and a super awesome, great cost seg. See any more questions here, Mitchell, that you might want to dive into?
No, this looks good.
This is a really good one. Yeah, this is such a common event is that a business owner buys the building that they're operating in. Tim has a client, owns an electrical company. He meets the hours and material participation as he's in, this electrical business. Does he need to qualify as a real estate professional to deduct his own building that are in, integral parts of his business? And the answer to that is no. He doesn't actually have to be a real estate professional if these are core parts of his business. Is that correct, Mitchell?
That's right. But I'll say also, this guy might be a real estate professional because he spends 750 hours and more than half his time, you know, the, I'm trying
on
to
his own
find
real estate on his own real estate project. Second one from the bottom. Yeah.
It's developing, redeveloping, you know what I mean? He is there. So, this might be a double, but if he were a dentist and bought his own building, the building would be an incidental item, just like if you bought a forklift, just like if you bought a new chair.
So that sounds
whatever.
like an amazing way for, small business owners of all kinds to offset a ton of their income is to buy the building that they operate in, do a cost seg study, and then depreciate a ton of that against their business income that year, and then set up a master lease with their business to make, passive gains. You can deduct any interest that you have on this business. So, or on this piece of real estate. So I think it's just a really great plan to offset in the near term.
You don't want to rent your building anyway,
To yourself, I mean, rent it to yourself.
Yeah, no, but I'm just saying you want to own the building you operate out of. All these
I see.
restaurants and stuff, they go rent, and then if you run a successful restaurant and you get like 15 years into running a successful restaurant and all of a sudden your lease comes up and your landlord just crucifies you and starts to take, a third of your gross margins. It's just brutal. So
Hmm.
business is hard enough without renting real estate. So
Yeah. This guy's got a good answer. Good question. Braden says, I work for a real estate developer and on his portfolio. I'm paid 60K salary. I make an additional 200K in 1099 fees that I do through my own consulting company. Can I argue for that I'm a real estate professional, or should I
yeah,
negotiate my salary into all 1099 basically?
I've seen this both ways. I mean, like the most the safest bet is going to your developer or going to your boss and saying like, why don't we just set up a payroll entity and I'll own 5% of that entity and you can pay me 60. Like I had that where a bunch of
Hmm.
principals went
Hmm.
together and they just structured the kind of payroll entity of the business so that they could all own 20% of their payroll entity. I mean,
Hmm.
that's the safest way, but look, go set up an S corp and start paying yourself a salary out of that S corp, and you all of a sudden work for yourself, and you're spending. I'd pay yourself a higher salary than the 60K just to argue that you're working more hours for yourself. But the safest way is obviously to just get it structured completely right. I'd also just say talk to your attorney, talk to your accountant, but I
Yep.
think there's a workaround there. I mean, I think you're a real estate pro, Braden, but I don't know. Good luck. I'm
All
just
right,
on the
so
internet.
we're gonna call it off at that, Mitchell. Thank you so much for your time. And look, if you're watching this again, just visit recostseg.com, fill out the form, and you can get a free proposal. We'll turn it around in a couple days and let you know what amount of bonus depreciation you could potentially get. But thank you all so much for watching. Thanks for supporting Mitchell and I online, and thank you for potentially giving RE Costseg a chance to earn your business. Have a good rest of your week.
Appreciate it. We'll get this spun up and get it shipped out later in the week. And yeah, we'll do another one of these sometime soon.
Thanks, Mitchell. Talk soon.
Thank you, man.